Welcome to Edison TV. I'm here with Iain Daly, Analyst at Edison, to talk about Euromoney Institutional Investor. Iain, thank you for joining us today.
Thank you.
Could you tell us firstly about Euromoney?
Certainly, well, Euromoney is a £1.1 billion market cap business information publishing group. It also, not only does it publish information, it also hosts a number of investor events and conferences around the world. The group is primarily focused on the North American market, emerging markets, and also Western Europe. It also has an exposure to the UK sector as well. The main thing for people to know about Euromoney is it's highly focused on international capital markets. So a very large chunk of its business comes from servicing the information needs of the banking industry and capital markets industry all the way around the world. It also has quite a significant exposure to both hard and soft commodities, publishing a series of titles, commercializing databases and providing events and trainings within those areas.
So transition has been a buzzword within publishing for the last few years. Is Euromoney any different?
Well, yes, it is. You're right to say that transition has been a big theme because traditionally publishers publish magazines, and the way the world has developed over the last few years with sort of the digital evolution we've seen is that has become a very challenging model to sustain in a modern world. So the pressure on publishers has been to diversify their revenue exposure away from selling advertising, particularly display advertising, to securing new revenue streams. And Euromoney has been very successful in that. Subscriptions now account for over 50% of group revenues. There's subscriptions to both print and online titles, and also subscriptions to information databases. The second thing they've done is they've been able to therefore reduce the exposure to advertising, both display advertising and also sponsorship. It still has a healthy mix of those within the group, which is quite important as they can be a very valuable and quite a high margin source of revenue. But overall, the group is less reliant on them, significantly less reliant than it has been over the last, say, up until about 2005. Why that's important to Euromoney is they've been able to buttress their margins as a result of that. And actually, Euromoney has one of the highest operating margins in its peer group. And that's largely as a result of its successful execution in moving away from traditional publishing revenue sources. The other thing about transition that's quite important to bear in mind is it's not just about how the company makes money, it's also where it makes its money from. And Euromoney does have quite a high exposure to markets outside of, say, the established City of London and Wall Street. And well over half the group's revenues now come from outside those areas. So in terms of diversifying its geographic risk, that is quite significant.
Given the challenges facing the international capital markets, where is Euromoney's growth going to come from?
Well, growth is difficult at the moment for all business publishing groups, and Euromoney is certainly no different. And the company itself has spoken about the challenging environment it faces. I suppose the key sources of growth for the company are going to be on targeting opportunities mostly relating to information. The group made quite a substantial acquisition back in 2006 when it acquired a company called Metal Bulletin. That company itself had within it a number of very data-driven and information-driven businesses, and Euromoney has been very successful in sort of exploiting those and growing them around the world. And that has been quite a significant engine of growth for the company. Whilst you don't anticipate that growth is going to be maintained at historic rates, certainly there is still more for those businesses to go. So I think the growth is going to come from managing its portfolio and targeting sort of information intensive areas within its target industries. And there I think there are a number of growth prospects. More generally, I think there are geographical growth opportunities. So the group does have quite a significant exposure to emerging markets. Roughly 28% of group revenues come from what they call what most people classify as being emerging markets, and those are still areas where there are quite good opportunities. A number of the brands that Euromoney has started off life in London, started off life in Wall Street, and actually have quite a lot of legs to penetrate into overseas markets. So that is something we've seen at the moment. The second aspect of growth story is about profitability as well as revenue. And as I've already mentioned, Euromoney has a very, very strong margin record. In fact, has the second highest margins in its peer group at the moment. And this is quite significant because the ability of the group to drive profit growth, even in a challenging revenue environment, does rather mark it out from its peers at the moment.
And so what are the primary sensitivities you believe that investors should focus on in the next 6 to 12 months?
We think there are two. The biggest risk the company faces when it's boiled down to its most simple point is simply its headcount within investment banking, global financial markets. Regardless of whether somebody's consuming a Euromoney product, either as a subscriber or as an attendee at an event, or someone reading one of their titles, fundamentally it is all about the number of eyeballs which are engaged with their data and their services. And the risks at the moment, I think, still probably lie on the downside as far as industry headcount is concerned. There has been a lot of news flow coming out of continuing headcount reductions at major global investment banks across a number of markets. We don't think that's necessarily going to change in the short term, and I think that remains an issue for the company. And the company itself has spoken very openly about this. And most people's revenue assumptions for the current year are for something in the region of sort of flat to even just sort of 1% growth. So I think that remains a very significant issue for the company. I think the second sensitivity that people need to be aware of is foreign exchange. Approximately 2/3 of the group revenues are invoiced in US dollars. And whilst at the moment that doesn't seem to be affecting the group too much, they do have a very active policy of hedging forward. They hedge forward approximately 50% of their revenues on an 18-month basis. So we keep an eye out on the movements in exchange rates. At their last trading update, which was at the back end of March, the company did say that they weren't anticipating any material effect coming from exchange rate movements, but it is something people need to be aware of going forward.
Well, Euromoney's is one of the highest valuations in its peer group. Is this sustainable?
Well, yes, it is, and it's partly because who else is within the peer group and how Euromoney stacks up against those. And I think one of the things that people have really sort of picked up on and really focused on the last couple of years with Euromoney is two things. One is the company enjoys arguably some of the best visibility within its peer group, partly because of its exposure to information-based sales subscriptions, which tend to be sort of rolling forward for a year. That is very, very helpful to them. The second thing is that they say their operating margins. That really is the sort of the yardstick of how well a management team are able to execute. What is interesting is that in 2005, Euromoney's operating margins were 21%. They're now 30%, and yet that encompasses probably one of the worst financial recessions or financial market recessions that we've had in living memory. And I think that is indicative of how well management team have been able to drive the business during this period. Secondly, the Euromoney has one of the best balance sheets in the sector. It is fundamentally clear of debt in the absence of further acquisitions it might make. It has already made 4 acquisitions so far this year. They tend to be relatively small but highly accretive to the group. They certainly focus on areas where there is an opportunity, be it a sales opportunity or a geographic gap that they may have. And Euromoney has a flexibility that most of its peer group doesn't. So certainly when it comes to bolstering growth going forward, M&A is a big opportunity for them, and they can probably execute that better than anybody else. One of the final points to recognise is that Euromoney itself is not is a subsidiary of a larger group, which is the Daily Mail and General Trust. And although it is run as a wholly autonomous subsidiary, it is able to leverage its parent company's strength. So again, from a balance sheet perspective, there is effectively a very hands-off but highly supportive parent standing behind the group, and that has allowed management, I think, a great deal of flexibility in terms of how they approach things like mergers and acquisitions, and making slightly longer-term strategic decisions rather than just focusing on the short term. And I think that has held them in pretty good stead. So currently they're trading on 14 times prospective earnings. The peer group's on about 12 times. And I think that looks about right at the moment. We wouldn't anticipate the multiple expanding significantly from where it is, but we think the investors have a greater faith in the Euromoney story than they probably do elsewhere in the peer group.
Iain, thank you very much for joining us. And for more information, please visit the Edison website.